Good afternoon here. Mark Panazon, mortgage broker and partner with Mortgage Connection. Hope you're having a great day. Here is your monthly technical analysis update for September. We have 12 things to review today, so let's get started. Number one, bond yields. Bond yields as of late, same story, just continues to drop. You can see here we had the news of the Bank of Canada rate cut here in September. A couple weeks ago, and the bonds certainly fell, small rebound, but you can see where this story is going. If you zoom way out, rates are trending down. We've peaked here October of last year, and we've had nothing but good moves down. And as rates continue to cut, you'll notice that this will also continue to cut, which puts fixed interest rates in a much more interesting and appealing state than we've had over the last little while. Now, we're probably not going to go back to these pre-COVID or COVID lows, which is around here, when the bonds were hovering around less than 1%. Bonds are currently at 2.75, but it is a nice move down, and I would suspect we're going to end up somewhere around 2% over the next year. So there could be an additional 0.5% to 0.75% of rate cuts over the course of the next year, year and a half, as the Bank of Canada continues to cut rate and inflation remains low. Next is the Bank of Canada overnight rate and inflation. So this obviously is another big story. If we look at the monthly chart here, you'll see that our inflation numbers are well under control now, within the 2% target at 2%. And the Bank of Canada loves this. The Bank of Canada made their first rate cut on May, and you can see that inflation continued to dropped again, and so we've had 3 cuts in a row. So we're down to 4.25 on the overnight lending rate. This is the Bank of Canada controlled rate, which is their main tool to fight inflation. They upped rates when inflation was high, and now that inflation has dropped, they're going to be lowering rates. What's interesting, if you just kind of zoom out, you can see that for the most part, this has been the trend over the last few big cycles here. You can see all the big arrows, which are the big moves down for the Bank of Canada rate, which coincides with inflation also dropping. And then when the Bank of Canada upped rates, inflation typically increased as well. So good news, really good news. We're finally back into the course here. Here is the projected drop of interest rates based on the monetary policy report, which we'll bring up here. No real changes here. We were at 5% earlier in the year. They're projecting a 1% cut and then another 1% cut next year. This hasn't changed. So we were at 5 to start the year. We're currently at 4.25, right on pace to have at least one more rate cut this year. And I actually think it's probably going to be more than one rate cut. And then at least 1% rate cuts next year, which again, I think it'll be at least 1.5 probably, or even close to 2% of additional rate cuts. So we have a long ways to go, but it's a nice trend to see that rates are finally starting to come down. What's also interesting is you got to look at the U.S. picture as well. And it's kind of a similar story. Inflation here in the red in the U.S. peaked right around 9%. In June of 2022, we're now down to 2.5. The metrics are kind of the same for the U.S. They want like at around 2%. They're not quite there yet. They're at 2.5%, but the Fed finally cut rates after a long pause. July 23 to August 24th, solid year of no movement, and then they just cut the rates, and they didn't cut it by 1/4 point. They cut it by 0.5%, which is considered a pretty large cut. Typically, the cuts are in 1/4 point moves. So to cut it 0.5% instead of 1/4 on the first go is big moves. And we know that the Canada typically follows the U.S. And so a lot of people believe that rate cuts will be faster and deeper in Canada going forward, which kind of puts my point forward that these rate cuts that Canada is suggesting will be even deeper and even faster than this slower 1/4 point at a time, based on the monetary policy report that they published a while ago. So really good news that the Fed finally cut rates, which was, September 1st? No, I think it was sometime I think it was last week when they actually made that move. Moving on to Canadian employment. So Canada employment numbers continue to increase. So this is great news for rates cutting, not so good for people trying to get jobs. In fact, there's You can see that the number of employed people rose by 60,000 from the previous month to 1.4 million. So, there's a lot more people in Canada, and there's not as many jobs available. So unemployment rates keep increasing. This is a measure that the Bank of Canada will look at to, make them feel more comfortable to cut rates. You can see that this trend really has been increasing ever since spring of last year. So there's nothing slowing it down. Hopefully, that will encourage the bank to continue to cut rates. So good news for rates. Next is Canada GDP growth rate, super flat. Look at this, barely chugging along. I mean, 2 negative quarters in a row is the definition of a recession. So we haven't technically been in a recession, but if you look at these 2 months here, or these 2 reporting periods, which was Q3 last year and Q4 last year, basically right around zero. We had that recession. We're rebounding, but very flat numbers. More encouragement that the Bank of Canada will cut rates in the future. Housing starts. So some housing data here. So nothing really new here. You can see that housing starts fell by 22% to about 217,000 units in August from the month prior. So we're not building that 500,000 homes a year that the Liberals promised 6 months ago with their very aggressive housing plan. It's not working. We're still not building as many homes. We're building the same amount of homes as we built in the 70s, and we have twice as much population. So housing continues to be a problem. If we look a little deeper into some of the housing numbers here, you can see that nationally home sales edged up 1.3%. You can see that if we just dig right into these charts here, you can see that the monthly home sales number is pretty flat, sort of trending up, but not much movement here. You can also see, let me just click through these stats here. Sales activity has been fairly flat as well for the past 2 years, basically. So, not much sales activity. We're kind of in this sort of down market while rates have been suppressed. So that's not unusual. If you look at the average price of homes, they've also peaked out, obviously, January 22 after the post-pandemic high. So we had that low rate period, which encouraged everybody to jump into the market. Rates increased, and then rates have dropped off, and they're sort of starting to balance out a little bit more. If you look at the average price year over year from the different provinces, no surprise here that BC is slightly down and Ontario is slightly down. And look at places like Alberta and Saskatchewan, New Brunswick, Maritimes, all prices skyrocketing with all these interprovincial migration coming into the provinces. So if you're looking at the benchmark price for different types of homes, obviously the 2-story single family is going to be at the highest price point. But again, they've peaked and then they've come back down, hopefully kind of in that trend and starting to slow down. I don't think this number is going to come down at all just with the supply and demand issues in housing, but it gives you a little sneak peek there. The last 2 things I want to go over are the interest rates. So they keep moving down, so we're in a really good spot here. If you look at the lowest rates overall, it's still this very flashy 3.99 with Marathon. This is a 6-month term, so it's not a long term. It's just a sort of a, sign up with us right now. You get a really low interest rate. You do have to re-sign with them to avoid penalties. So it's an interesting way to do things. But if you're looking at the more traditional terms, 5-year fixed, you can get as low as 4.19. Some of the banks are going to be a little bit higher at 4.5 with TD, 4.6 with Scotia. But certainly we're in that time of, low 4s, which haven't been in the low 4s in a while. And I think, give it 6 months, we'll be in the high 3s, hopefully 3.5% by next summer. That would be a nice target. So I think locking into a fixed right now is not the worst idea if you consider where fixed rates have been. We've had very low interest rates. If we look at the monthly chart, we've had very low interest rates for sort of this period of time here where bond yields were kind of averaging right around, let's see here, if we got the 200-day. Oh, can't show you that one. But you can see that they're kind of averaging, say, right around 1.5% sort of for this period of time here. And then we have this big blow up. So if we can somehow get back to pre-COVID highs right around 1.6%, that's about 1% lower in interest rates. That would make things very appealing. So if you can get to that, 3.2, 3.5%, that would be worth locking in for the long term. If you compare that with the variable rates, which are obviously still going to be higher than fixed rates, we're going to be in that 5.3 to 6.2% range. So still quite a bit of big buffer. Banks again on the higher end at 5.7% on that 5-year variable. So something to keep in mind, if you look at the insured mortgages, which are always going to be that lowest rate, it's that 5.3 to 5.7 range. So and Manulife, has that very unique one product, so it's really closer to probably 5.5% for a lot of these lenders. You can see they're all in the middle there at 5.5%. Anything short isn't really ideal. The 1-year terms are still very expensive. You'll see that the 1-year fixed is starting at 5.8, which is finally we're in the fives. We've been at 6% for a while. A lot of these guys are still at 7.5%. The 2-year is a little bit better. You're still in the fives at 5.3, 5.4. Scotia's 5.6, TD's 5.8. But the 3-year, if you're going to think shorter, is that sweet spot still. It's been the sweet spot, number one seller all year, where you can still get about a 4.5% for 3 years. You don't have to commit for 5. You can get out in 3 years' time and then hopefully lock into like a 3.5% rate in that time, if you don't believe in the variable. So how do you kind of put this all together? Well, you just basically got to go to our simulator here, fixed versus variable. If I take a 500K mortgage, 25-year AM at that lowest 4.19 rate, compare that to the 5.3, which is the lowest variable rate, you'll see that the rate is, or the payment is $2,600 per month versus $2,900 a month. And then if we price in different rate cuts here, you can see the 2 rate cuts that we're anticipating this year, then an additional 1% rate cuts next year. It's hard to predict exactly when the bank will cut, but given the US Fed just cut 50 basis points, any one of these could be a lot more. But if we keep it pretty vanilla and go with another 1.5% of rate cuts, which would tie up with the monetary policy report, we're at 4.25, and they're anticipating 2.75 to 3. So that's about your 1.5% in additional rate cuts. At the end of the 5-year term, choosing the variable rate mortgage based on the simulator would save you about $5,000. So on a sort of base case, 4.19 versus 5.3, variable seems to have the number. You start to break even right around a year, 12 months. Again, very dependent on fixed versus variable rates, but it seems like variable rate, if you have the guts and the tough skin for it, would probably save you money. And if you're waiting 6 months to buy a home, you'll get so many more rate updates and have a much clearer picture. But if you're right now trying to make that decision, it is tough. I think 4.1% is very reasonable for a fixed rate. You have to kind of think about where we came from. But then again, if you got the skin for it, then the variable should win out. And even if we get a little bit more aggressive with some of these rate cuts, let's say they do cut 0.5%, this next one, but then they just remain pretty vanilla for the rest of them, that 5,000 savings doubles. So you can see it's very sensitive to these rate cuts when we do this comparison and when you buy. So if you have a situation that you'd like me to compare for you, let me know. We can run the scenario in this awesome simulator and figure out what would be the best product for you. So that's all I have for today. Hope you guys have a great day, great month, and we will touch base with you next month. Take care.